Our entire global economy, it really runs on numbers. But how can we actually trust those numbers? Who's making sure they're legit? Well, that's where the international standards on auditing come in. Today, we're going to break down this essential playbook, piece by piece, to show you the real anatomy of a modern, high-quality audit and how it builds the trust that our whole financial world depends on.
Okay, so here's our game plan. We're going to walk through 5 key stages. First, we'll tackle the auditor's core mission, the fundamental principles. Then, we'll get into the crucial planning and risk assessment phase. After that, it's the real detective work, gathering evidence. Then, we'll see how auditors collaborate and use others' work. And finally, we'll wrap it all up with how they deliver that final verdict.
So let's kick things off with part 1, the auditor's core mission. Before an auditor even opens a single file or looks at a spreadsheet, there's a whole foundation of principles and responsibilities that has to be built. This is the bedrock. Everything else rests on this. Now, this is so important to get right from the very start. It's about drawing a clear line in the sand. On one side, you have the company's management. Their job? To prepare the financial statements and build the internal controls that make sure those numbers are right. On the other side, you've got the auditor. Their job is completely separate. They're the independent watchdog, there to scrutinize that information and give a totally objective opinion. So management tells a story, and the auditor's job is to verify if that story is true.
This brings us to maybe the most critical concept in all of auditing: professional skepticism. And no, this doesn't mean auditors are just naturally cynical people. It's a professional mindset. It's the constant attitude of trust but verify. It's that voice in your head that says, that's an interesting claim, now prove it to me. So instead of seeing a huge spike in sales and just saying, great, the professionally skeptical auditor says, okay, show me the customer contracts. Show me the shipping records. Let's see the proof that the cash actually came in. It's that relentless, critical assessment of evidence that defines a quality audit. Think of this part as the pre-flight checklist for the entire audit. You wouldn't want a pilot to just jump in the cockpit and take off, right? Same idea here. There's a formal engagement letter that sets out the rules of the game. The audit firm itself has to have top-notch quality management systems in place. And the lead partner, they're the captain of the ship, taking ultimate personal responsibility for the quality of the work. It's all about making sure the team is competent, has the right tools, and is ethically prepared to do the job. It's completely non-negotiable. All right, moving on to part 2. So the foundation is solid. Now what? Now it's time to build the blueprint for the actual investigation. This is where the auditor creates a detailed game plan to make sure they focus their precious time and energy on the areas that matter most. Planning an audit really happens on 2 different levels. First, you've got the audit strategy. This is the big picture. It's like deciding, we're going to drive from New York to Los Angeles. It sets the overall scope and direction. But then you need the audit plan, and that's your turn-by-turn GPS. It's the nitty-gritty details of exactly which procedures you're going to perform, when you'll do them, and how deep you'll go. One is the destination, the other is the detailed roadmap to get there. You just can't audit a company in a vacuum. To find potential problems, an auditor has to basically become an expert on that company and its environment. They need to get deep into the weeds. What industry are they in? What are the pressures? What's their business model? And critically, they have to understand the company's internal control system to identify the weak spots, the places where errors or even fraud are most likely to hide. Okay, let's talk about a really crucial filter that auditors use called materiality. Look, auditors are not there to find every single missing penny. That would be impossible and honestly kind of pointless. They are hunting for the errors that are big enough to actually matter. The ultimate test is this: would knowing about this misstatement cause a reasonable investor to change their mind about buying or selling the company's stock? If the answer is yes, then boom, it's material. That's what they focus on. And that brings us right to the heart of the matter, part 3, gathering quality evidence. All that planning, all that risk assessment, it all leads to this. This is where the audit team rolls up their sleeves and does the real investigative work to collect the proof they need to back up their final opinion. Now, when it comes to evidence, it's not just about getting a ton of it. There are 2 pillars here, and you absolutely need both. On one hand, you have sufficiency. That's the quantity. Did we get enough evidence to support our conclusion? But just as important, if not more so, is appropriateness. That's the quality of the evidence. Is it relevant to what we're testing, and is it reliable? Getting a verbal confirmation from an employee is one thing, but getting a written confirmation sent directly from the company's bank, that's a whole different level of quality. So how do they get this evidence? Well, they have a whole toolkit at their disposal. This isn't just about sitting in a room with a calculator. They are out there doing stuff. They inspect physical assets, like counting inventory in a warehouse.
They observe the company's processes in action. They send out external confirmations to banks, customers, and suppliers. They recalculate complex figures themselves. They use data analytics to spot weird trends. It's a real, hands-on, multifaceted investigation.
And this leads us to the golden rule of auditing, something you hear all the time. If you didn't write it down, it didn't happen. The audit documentation, the work papers, has to be a perfect record of everything. The goal is that another skilled auditor, someone who knows absolutely nothing about this company, could pick up that file years later and understand exactly what was tested, what was found, and how the final conclusion was reached. It's its ultimate record of accountability. Okay, on to part 4. Auditors are not lone wolves. I mean, the business world today is way too complex for that. So let's talk about how they can leverage the work of others, but do it in a way that's smart, safe, and doesn't compromise the quality of their own audit. This usually happens in 2 main ways. First, they might be able to use the work of the company's own internal audit team for certain tasks, which can be super efficient, but only after they've done a thorough evaluation of that team. The other way is bringing in their own specialist. If you're auditing a high-tech company with complex patents, you, the accountant, aren't expected to be a patent valuation expert. You engage one. That's an auditor's expert. So before an external auditor can rely on even one piece of work from the internal audit function, they have to put them through what I call the trust test. They have to ask some really tough questions. Is this team truly objective, or do they report to the very people they're supposed to be auditing? Are they competent? Do they have the right training and skills? Is their approach systematic and disciplined? Only if they pass this rigorous test can their work be used. And we've made it to the grand finale, part 5, delivering the final verdict. After all the planning, the risk assessment, the evidence gathering, all of that intense work, it all comes down to this moment, issuing the formal public audit report. Now, the auditor's report isn't some creative essay. It has a super specific, standardized structure. And that's a really good thing. It means whether you're looking at a report from a company in Tokyo or Toronto, you know exactly where to look to find the most important information, the final verdict right up top, and the reasoning behind it. Now, the best case scenario, what everyone hopes for, is that clean, unmodified opinion. That's the big thumbs up, saying the financial statements are fairly presented. But that doesn't always happen. So what happens when an auditor finds a big problem they can't get management to fix? This is where the auditor has an escalation ladder. If they find a material error, but it's isolated to just one specific area, they issue a qualified opinion. It's like saying, everything here looks good except for this one thing. But if the problem is pervasive, meaning it's so significant it infects the financial statements as a whole, they issue an adverse opinion. That is a massive red flag that basically means, do not trust these numbers. And there's a third path. If they simply couldn't get enough evidence to form an opinion, they issue a disclaimer of opinion, which is them saying, we couldn't do our job, so we can't tell you if these numbers are right or wrong. And for public companies, there's this extra, really fascinating section now called Key Audit Matters. This is where the auditor pulls back the curtain and tells investors, okay, here are the 1 or 2 areas in this audit that were the trickiest, the most complex, the things that required our most significant attention. It gives you a peek under the hood of the audit, highlighting what really kept the auditors up at night. It's incredibly valuable insight. So when you pull it all together, what's the real takeaway? These standards, they're so much more than just a technical rulebook for accountants. They create a single, standardized, global language of trust. It's this shared playbook that allows an investor in London to confidently put their money into a company based in Singapore, knowing that its financial story is being held to the same rigorous standard. In our interconnected world, these rules are a fundamental pillar holding up our entire global economy.